Today's webinar is Getting Real About Inflation Strategies. My name is Andrew Gradis. I'm the Director of Investment Consulting at Adhesion and the host of today's program. Today's webinar will be approximately 30 minutes in duration. That's going to include time for Q&A at the end. Today we are joined by two fantastic guests. We have John Forlines and Richard Brink. They've joined us to discuss inflation trends and how they are investing in the current market environment. You may notice myself and John on the line. Rick is here as well. Just camera issues, but he'll still have a lot to add verbally. So quickly, background on our speakers. John Forlines, he's the Chief Investment Officer and Portfolio Manager at Donoghue Forlines. John also teaches at Duke University, where he focuses on behavioral finance and decision-making in Duke's Department of Economics. Now, we also have Richard Brink. Rick is a Senior Vice President and Market Strategist at AllianceBernstein. Rick has held prior positions in the alternatives and multi-asset groups, as well as a Senior Fixed Income Portfolio Manager. So, Rick, John, thank you for joining us today.
Thanks for having me.
Very good. So, yeah, really, I wanted to set the stage real quickly for our conversation. I think it's really an understatement to say that there is a lot going on. I think everybody on the line is acutely aware of that. We have inflation that is the highest that we have seen in 40 years. You know, increase in prices of 7.9% over the past 12 months. Advisors have the challenge where they're searching for yield, and we're in a negative real rate environment, so increasingly challenging there, and that makes bonds very unattractive. We have a more hawkish Fed that we know we're going to be hearing from later this week, and then you take all that and you compound it by a war in the Ukraine. It's really a lot for everybody to have to absorb. So with that backdrop, I'll start with a question for John, actually, and it's, while this call isn't focused specifically on the FOMC meeting this week, these issues that I outlined, they're critical to the Fed and, our focus on inflation for this conversation. So, John, if you could, describe the current inflation environment and the landscape relative to investing and allocating portfolios. What are the challenges that are different than what we've seen in the past, and what are we navigating? Oh, and John, it looks like you might be muted.
Sorry about that.
There we go.
A quick summary of where we are is, yes, inflation headline core, everything you can think of is at a 40-year high. And it's not just energy prices, but although energy prices is a huge component of it, and also, we have some lots of dislocations, not just in the demand supply part flowing from the pandemic and the recovery from that, but also in the labor market. There's a tremendous, the quit rate's been incredibly large. People are moving around, and the question is going to be, how durable the kind of inflation we have is now, really what it comes down to. If you break down the components, what we look at mostly is the PCE, the inflation number, which helps you focus on which segments of the economy are actually experiencing a lot of inflation. And what you see is we've got a tremendous amount of goods inflation, but if that actually should fall toward the end of the year. So the question is going to be, hey, is the Fed going to react, and it has in the past, to really high asset prices, or it's going to look for more indications that there's a runaway economy with respect to wages and employment and all that? And I think the data on that's pretty mixed. So that's the backdrop. And so the question is, can the Fed manage it again, or will they blow it? And I just, as parenthetical, tell you, every time we've seen a recession, it's generally because central banks have overshot and caused it. So it's generally not inflation. You have, the only exception to that I can think of was the bizarre, post-Vietnam years. But if you look back to 2011, same thing happened. All the hawks are claiming that inflation's out the roof. Bernanke held fire and it turned out to be the right move. I don't think that's the right move this time. There's probably going to be a gentle rising of rates, but I don't think we're looking at anything that's close to matching the peak where we are. So that said, in an allocation context, it's sort of, you got to really stay the course and do what we call some factor tweaking. You've got to basically take into account there's goods inflation, there's going to be winners and losers there. And we're an index firm, so that's easy for us to do and focus on and make the changes. And you've got to be really careful about how we allocate to pure bonds. So the things that we're focused on are the right amount of equity, which is really haven't reduced it. And the only thing we've done is reduce the pure exposure to bonds, and added to credit positions and hope to add it more to credit positions. And of course, we've added to our DFRA position, which is real yield enhanced alternatives. And that's been the money shot for this year. And I think that's what we're going to be probably continue doing for the rest of the year.
Great. And Rick, I'll give you the same question, see what else you might have to add. Current inflation landscape relative to investing and allocating your portfolios. What are you all? How are you all viewing it at AllianceBernstein?
Sure. Well, I mean, first, I'll echo John's comment about the original and still champion, if you will, driver of a lot of the numbers, which has been goods prices. For 10 years before all this happened, the Fed was struggling to get inflation to its target. It took a pandemic to hit the trifecta that John alluded to, which is demand and supply also relating directly into labor and what he talked about. I mean, keep in mind that if you look at GDP, the amount of consumption in goods in the GDP number pre-pandemic to during the pandemic grew by $1 trillion. It's like, I often joke, if it was an Oprah Winfrey show, it'd be like, you get a Peloton, and you get a Peloton, and you get a Peloton. And so when you do that, you're going to overwhelm supply chains. Even if there isn't a pandemic, the pandemic affects labor in factories and also affects soft touch and everything that we've seen. And so, the thing that you're watching as we go through here are the stars of goods inflation. Many of you know that used cars, for example, are up over 40% year over year. And there's usually a unique cocktail around each of the ones that are really starring. Now, what's happened more recently is you've seen it broaden out a little bit. Obviously, shelter becomes a big thing to look at inside of services, but a lot of this still centers on recovery from COVID, and that's what makes it so challenging. I've said from the beginning of this, the virus will tell us how this is going to play out, or variants of the virus, as we've come to see. But generally speaking, that's the high level case for us, as well, is that over time this moderates. Our forecast is that you get toward where the Fed was sort of tracking or looking for at the back end of this year or into the first part of next year. But the thing that we think it does do is that inflation number for the 10 years before was coming in under 2%. Maybe now, instead of 1.5 to 2, we're thinking it's 2 to 2.5. Now, something to keep an eye on that's, we can talk about in Q&A is non-pandemic inflation drivers. So there's been a lot of discussion within our firm for years about some of those drivers that kept inflation down, the rise of globalization, automation, all of that. And as that fades, as demographics, which were once a major driver, start to turn into a neutral to a headwind, there are factors around that also could produce its own form of inflation through policy and structure of the economy. So in terms of what we're, and then of course, energy, by the way, energy and food, that's a much more difficult road to hoe in terms of forecasting it, because it is obviously, as we all know, tied to geopolitics. But it does speak to the idea that you have to keep an eye on whether or not that remains persistent, because it doesn't sit inside of, say, core PCE that the Fed should technically be looking at, but it will directly feed through to growth and have an impact on the Fed, of course. So, but generally speaking, that's our sort of take on inflation through the years. We're going to settle at some point beyond all of this unless geopolitics goes really squirrely at a level that's probably 50 basis points where we came into it. Now, what do you do about it? John already alluded to several stuff. So I'm going to hit a couple of the finer points within income, just so we hit something a little different. And so it's the idea that John was alluding to in terms of owning credit. We think of income as sort of explicit, implicit, or just in general. When you're trying to inflation protect, there's explicit and implicit. In the fixed income world, think of explicit as buying a tip. It's adjusted based on what inflation actually is. Think of implicit as something that helps you fight against rising inflation, or in this case, just rising yields in general. Credit classically, because the spreads offer you a higher level of yield, gives you some level of buffer. And then generally speaking, if you do have a rising inflationary environment, that tends to actually bode well for the real level of debt, inflation level of debt, so adjusted level of debt. So for us, when we talk about fixed income today, and given where real yields are that Andrew alluded to, it's about blending your explicit protection, your tips, if you will, with credit to find a balance between that. That's generally what we refer to as a barbell. It affords you a higher level of base income, gives you a fighting chance to get real yields above zero should inflation fall back down toward that 2.5% over time, 2%. And it provides a balance through the backdrop. In terms of the equity side, one just final point I'll add there is, certainly at a factor level, there are areas of the markets that have classically been good inflation protectors. It can be the equity of real asset producers, as John was alluding to real assets. We can do that through the equity space as well. Somewhat controversially, value over a long period of time shows a reasonably good signal toward inflation protection, but it just hasn't been the belle of the ball for a lot of other reasons for quite some time. But I tend to default to the idea that when you're inflation protecting, there's a trade-off you're making. And that's between the actual explicit or implicit inflation protection you're seeking, and then the opportunity cost of making that trade. In other words, I'm trying to generate solid market returns, but at the same time, I'm trying to inflation protect. And a lot of the times, those are at opposite ends of the spectrum. So take tips, for example. You can be explicit with tips, but you're walking into one of the lowest yielding parts of the markets. You're walking directly into real yield exposure with a pretty decent amount of duration, just as the Fed's tightening. And so there's a little bit of a frying pan and fire thing where I can avoid the frying pan of inflation by protecting against it, but am I diving into the fire of direct exposure to rates as the Fed is aggressively looking to tighten? And so trying to mitigate that trade-off between inflation protection and what we'd like our portfolio to look like if there wasn't any inflation is where we're trying to get to the middle. And for equities, what that tends to mean for me, in addition to looking at some of those factors, is looking to companies at a corporate level. Because classically, one of the best ways for you to inflation protect in equities, especially if inflation stays in the 2 to 3% range, is to do so at a broad equity exposure level, and specifically if you can then tap into companies with better ability to pass through pricing pressures. And so think about that opportunity cost trade-off thing. Against that backdrop, in theory, I should be able to remain well diversified across different parts of the equity market, which is something we'd always try to do. But then I can sort of tap into the idea of implicit inflation protection by the nature of the companies that I select inside of it and their ability to defend against those inflationary pressures. That's my opening salvo, Andrew.
Great, thank you. And Rick will actually start the next question. We'll go ahead and keep that with you. So both you and John have highlighted some areas that you're leaning towards and better ways to deal with the inflation environment. But to give our attendees, something specifically actionable and more that they can chew on potentially is what should advisors do specifically today? The market's very different today than it was certainly decades ago, but different than, just the past couple of years ago as well. So more specifically, how should they shake up the classic 60-40 stock bond allocation? What should they be doing differently within, whether it's the asset classes, whether it's that mix overall? What specifically should they be looking at?
Okay, so this is only going to take about 3.5 hours. Everybody settle in, grab yourself a snack. I'll go through this as quickly as I can. Now, it's a great question. It's the question I get asked all the time, and it's been heating up through this year because the reality is that we've been weaned on 60-40 for the last 4 decades. And there are a lot of challenges to that classic balance framework, most notably within fixed income. I mean, the whole role that fixed income is supposed to play, or was in the beginning when it was designed, was a higher level of yield, so therefore a reasonable level of return when put up alongside equities. But then again, this negative correlation that we became accustomed to, right? So it had directionality. If you go the other way of equities, it offered its own level of returns. And so that was a perfect mix. But as yields have fallen over the decades, then that becomes impaired. One, because when there's nothing to see here and the market isn't rolling over, then the yields are just simply low and in more recent times well below the rate of inflation. And if things are bad, its ability to offset is impaired by the fact that you're starting from such a low level of yield. So for both income and income focused 60-40 portfolios, so classic 60-40 with an income bent, and then just 60-40 in general, the first thing to do is to consider attending to the fixed income side. Now, I mentioned the barbell before, so I'll default to that. There's that trade-off. It's basically saying, I'm going to add more credit into the mix. I'm going to balance it with rates. I'm going to give up some of that offset that equities, that it's classically had to equities. So my correlation will rise a little bit. I'm going to balance the income source inside of it. That gives me that higher level of income when there is nothing to see here, but maintains a level of interest rate exposure to give some level of defense. As a sidebar, given where rates are right now, there is that idea that we're sort of getting toward the top end of where the 10-year is going to settle by the time this is over anyway. So for those concerned about where rates are and where they're headed, there's definitely some upside potential. But I think we're well past and into the last innings or later innings of where that would get to. But the bigger thing, too, beyond that is just, okay, so if bonds are impaired and I don't want to own a bunch of bonds, then how do I create that classic offset, that so-called counter-cyclical offset? And the last point I'll make and turn over to John for his thoughts is that we classically have thought about equities living on one side of the spectrum is fully pro-cyclical. When things are going well, that's what you want to own. And on the other side, in these scales of justice, we have fixed income, classically counter-cyclical, and things going really poorly. That's the thing you want to own. You put them together, and the mix, the recipe, works out well. But the thing is that on the equity side of the ledger, not all of those factors, those parts of the equity market are fully pro-cyclical. I tend to think about Donnie and Marie Osmond. I'm sorry I'm dating myself, but a lot of equity factors are a little bit country and a little bit rock and roll. It means that they have the equity pro-cyclicality, but they also have elements that are counter-cyclical that defend. Think about quality as a factor, for example. Quality tends to have almost an embedded option that based on the strength of the company itself. It's why quality as a factor tends to get most of a equity market's upside persistently, not all of it, but most of it, but it tends to defend far better when markets go down versus the broad market. And there are other factors like that. So in the interest of time, I'm happy to dig in during Q&A, but there are parts of the equity market that possess a piece of the way it behaves that is bond-like. And so there's the opportunity within the equity side of the portfolio to use some of those to almost synthetically produce a 60-40 right there inside of those specific factors, like quality and some others. And that's what I have, Andrew. Great,
thank you. Yeah, and John, same idea for you. And I know that 60-40 isn't a typical starting point for you. So, but how should investors be looking to, shake up the more classic asset allocations?
Well, yeah, and you allude to this, Andrew. We've never felt a 60-40 was the be-all. In fact, a neutral stance for us would be something to order a 50-30-20, or even in this market, that's almost for us, it's almost a perfect allocation, with the 30 being a lot of the instruments that including high yield and credit oriented instruments that fit that bill that Rick alluded to. So for us, though, the big kicker is in bull markets where you might increase that number up to 70. I feel much more comfortable with a higher equity number and a higher what we call real asset number, and squeeze the bond, the fixed income in the middle. Because as Rick alluded to, we can get into the question Q&A. One of the things that we spent 3 years developing was a yield enhanced real product that has REITs and MLPs and oil and gas exposure, things that we think, alluding to Rick's comments, that'll do well in inflation, but they'll also kick off yield. So for example, that ETF has in excess of 4% yield right now. So, it's a good place to be, and as long as the underlying is what I would call appreciating the economic environment we're in. And of course, those real assets are probably useful at all times, but in much more smaller quantities, say like I said, in markets that are more correlated in a traditional fashion, I guess I'd say.
Sure. Okay. Well, great. So I did want to open the lines for Q&A, so you can enter your questions into the chat. and then Kay will be happy to read those. But as we do that, just to keep things going, with things in Ukraine and a little bit of much more short-term uncertainty that we've seen, what are the key market signals that each of you are watching over the remainder of 2022? And we'll start that with John. And so what are the key signals that you're keeping an eye on?
Well, I think we both agree. You're going to keep your eye on goods inflation because that's really the problem here. And you also, I think, we're going to keep our eye on looking at in the moderate areas. So the 6 to 12 month futures market of where Fed funds are. That's going to be a really interesting tell. And I think by and large, right now, those tells are sort of in our camp, which are that, look, tons of the spurt of inflation caused by a number of factors, but it has to be carefully managed by central banks. Otherwise, you'll just, I do believe an overreaction is probably the worst thing we could possibly have. Despite what the hawks say, I think a gentle raising of interest rates over the period is called for. So those are the types of things. And of course, we're also going to look at an employment picture that's just been incredibly mixed. You mentioned wages are high in certain industries for sure, but in others, you can't get people to work. So, the backdrop is that, U.S. demographics are changing dramatically, like in other developed countries, and work, participation rate continues to fall. So, my guess is we really need to keep an eye on some of our traditional metrics. And I know the Fed's struggling with that too, is, what's really the problem in the underlying economy that we need to react to. And that's, that's the unspoken mandate besides prices and employment, right? That's really what's going on.
Sure. Yeah. And Rick, same question for you. It's, what are the market signals that you're watching throughout the rest of the year?
Well, I mean, the thing that you always want to watch right out of the gate is inflation expectations. I mean, that's the classic, the Fed is generally going to be okay with, okay being the operative word, with higher inflation in the now if it doesn't believe it's losing the ability to control the market's perception of whether inflation will eventually come down. Because if inflation expectations become unanchored and drive significantly higher and hold there, that's a whole different kettle of fish. So inflation expectations just in general. John mentioned goods inflation, of course. We'll be looking at some of those key drivers that we were talking about. So a couple of interesting things, for example, happened with new car sales here in the most recent release and all of that stuff. You're also going to watch base effects coming into play in different directions over the next 6 months. So remember, when the first big core inflation prints came out, it was with the reopening trade last year. And what that meant was, by the numbers, the biggest individual months of inflation prints were in those first few months right out of the gate. And so what we're getting to, since inflation is calculated by looking at the trailing 12 months, is we move into the next few months, you're going to start to see those guys roll off. And so it's kind of like trading 0.8 or 0.9% inflation in a given month for, let's say, 0.5 to make up a number that's been the last couple of months, or 0.4. And so you're going to, just off of the math, you're going to see the inflation number come down unless it's picked up by something else. And so you're going to keep an eye on the base effects, and you're going to want to compare that to what the more recent inflationary trends are, because they might be sending you different signals. In other words, that 12 months will show it dropping because you're dropping off the last few months, but you might see some inflationary pressure sort of pushing right out of the gate here. Another thing as far as the inflation story goes is going to be on the labor side. The Fed is really trying to figure out the size of the labor force. I mean, that's always going to be one of your drivers of inflation. Is going to be if you have a labor force that's basically has no slack in it and everybody's kind of working, then you're going to have much more of an inflationary impulse coming from wages and the search for workers because there's so many job openings. John alluded to the easy ability to quit and all of that stuff that's going on. And part and parcel to the labor force participation rate, we did see a little bit of good news in the most recent report there, which gave the market some happiness. If you want to dive in a little bit further, the biggest driver of that labor force participation reduction was in people 55 and over. And so what I'll give you like a sleeper indicator to look at, which is going to be the unretire rate, because classically people do retire, but then they turn around and come back into the labor force at some point, and that becomes a source of additional labor force participants. That's the part that's been held down pretty significantly here, is the lack of folks unretiring. So be looking, if we do get continued good news out of COVID over the summer, then perhaps you could start to see, as we get into the summer and the fall, continued slack, and that's going to give the Fed one more thing to think about to perhaps slow its rate of tightening. And one last thing is just watch growth. The expectations for economic growth is that they're strong this year, but weaker in the second half versus the first half. And so keep an eye on that as well, because if the Fed is facing inflationary pressures that start to tail down just a little bit, and they see growth tailing, then that's going to put a lot of question marks in their mind as they get into the back half of this year in terms of how much more tightening they're going to need to do. And that's what I have for that one, sir.
Great. Let's see. And so I just heard from Kate. So there are no questions on the line currently. If any of our attendees have any questions, you certainly can still have time to enter a question. But, just I guess for potentially the last question for two of you. I know I said early on this isn't really focused on the FOMC meeting, but in our conversation yesterday, one of the things that struck me is, I at least got the indication that you expect the Fed to take a little bit more dovish approach, given the uncertainty with Ukraine, the political economy that we're in, and things like that. Are either of you expecting any surprises, this week with the outcome of the FOMC meeting? So how would you handicap the overall expectations of what we're going to hear? And and like I said, yesterday I was a little bit surprised to hear both of you say, seems like you were expecting things to try to really be more of a gentle landing here.
Yeah.
And I guess I'll start that with John.
Yeah. So I think, so here's what I think is going to be going on in the markets. I think that the market volatility you've seen very recently, I think, has once again focused, as it has, I think, for much of the year, is what the central banks are going to do, right? So I actually think it's a buy the news type situation if you've been underinvested, because whatever happens, I think, going along with the way, Rick and I posited it, is let's just say it's a gentle first raise, and then you follow with another one maybe in the next month or whatever. That's pretty positive, I think, for markets. A lot of that's been, factored in. And then let's just say it's a hard jump, 50 to something else. Then I think they're going to take the foot off the pedal there for a sec, and let's see how that works. So in any event, getting back to the target rates we're talking about, the long-term target rates, I think that, we've just been in an era of 15, 20 years where we're desperately trying to goose inflation. I think, I think central banks have figured out what's the true nature of it and what are the drivers. You're going to end up at a lower place than a lot of the fears that you're seeing, I think, from a lot of bond market participants.
Sure. Great. Rick, any thoughts, any surprises, or what you're expecting to hear this week?
Well, I think Powell pretty much stood on his head and said it's 25 basis points. So that's unless he has an additional personality that's going to say something, I think that's where they're kind of going to end up here. If there's going to be 50 bips, it's going to be a couple of meetings down the line, in my opinion. But I'm also sort of thinking that, for the most part, it's 25 basis points. I wouldn't be shocked if there was 50 a couple months in. A lot of that, again, is going to depend on the inflationary pressures that are present. So the Fed's roadmap is almost like uncertain certainty, because they lay it out in a way, and then the market, as John mentioned, it prices in this expectation of rate increases, but really it's data dependent. This is going to happen as you move through the year. They're going to take stock of what's what's happening within markets. And even the we was talking about OIS and implied Fed funds, in the time ahead. We were talking about this yesterday. One of the goofier things that's been in that implied curve is that there's this expectation for a significant amount of Fed rate increases here, but there's also an expectation that there's a reasonable likelihood for Fed rate cuts as we get into 2023 and in the back end of the year. It's almost like the market's pricing in the Fed's going to aggressively go after inflation. By definition, it's going to be too much, and then it's going to roll over a little bit, and then they're going to have to cut because we're going to see some weakness. Any of those things are possible because Fed rates are not a scalpel; it's a sledgehammer, and so you have to sort of see how the economy takes the rate increase in over the 6 to 18 months it takes to get all of those impacts. But what I would also say is this, there's a way of framing this where the Fed, people talk about the Fed being hyper aggressive and going after inflation and wanting to keep it in check. And of course they do. But another way that the Fed is framed why they've gone earlier is one of risk management and normalization. We're starting from effectively zero in the Fed funds rate. And so if you looked at, if you visited from another planet and you saw growth where it is now and inflation where it is now and the labor force participation rate where it is now, you'd say to yourself, I don't think zero is the right number for the Fed funds rate. And so right now they're moving to almost rapidly get to a place that is quasi-normalized so they could be on the road toward their long-run or equilibrium rate of 2.5%. I don't want to put words in John's mouth, but if I understood his implication right, I would agree and suggest that I will take the under on that 2.5% by the time that the cycle ends, because that's happened for the last couple of cycles where the Fed overestimates the terminal rate of the Fed funds rate, and that might be the same thing here. Now, again, there's a pretty good argument that inflation settles above 2 when all the dust is cleared with some of these structural forces. But if you're somewhere in that 2 to 2.5, that's going to speak toward, again, an equilibrium rate that's probably not as high as folks think. And then, again, I know I'm doing John and I are agreeing back and forth with each other, but just sort of works out that way, is that, if you've already priced in a bunch of movement, remember, you don't need the Fed to move to have it showing up. I mean, the yield curve has been jumping for some time. The 2 years shot up already, so the market's run ahead of the Fed. So to quote Ragu, spaghetti sauce, it's in there, right? It's already been put in, even if the Fed hasn't already moved because the market's anticipated it. And so to John's point, if that proves not to be the case, and there's a reason to back off some of that number than what the market has already priced in, not just in the implied Fed funds futures, but in the yield curve itself, there's going to be room for air to come out of out of the balloon. And classically, if you've got moderate growth and effectively reduced yields versus expectations, that's a positive impulse for risk assets.
Great. Well, great. That so we're within our 30 minutes. So unless either of you have any specific closing comments, I want to thank both John, thank Rick for giving your insights today. Thank our attendees for dialing in to listen today. And so again, thank you both for attending.
Yep, thanks for having us, Andrew, and thanks to the folks at Adhesion.
Great. Thanks, everyone. That concludes our webinar for today.